TheoTrade. This is Don Kaufman. It's June 26, 2019, and you are watching the TheoTrade evening video. You know, we're just moments after the cash close, and the broader marketplace finished, well, with a relative slop fest. The S&Ps are down 4. The Nasdaq was up about 24. We laughed, we cried. I mean, people, this is just a Twitter-happy marketplace. This was actually Secretary of the Treasury. Over here was actually, again, some economic data that came out, a little bit of the administration talking. We spiked, we sold off again. I mean, this is a marketplace that's just looking to feed on any piece of information out there, which brings me to the overwhelming theme of this evening's video, and that is keep your risk wrapped tight. If you don't know what that means, okay, you better figure it out real quick. You better know what is your delta. Beta weight the delta. Beta weight it to the spiders. Know what your delta happens to be. I know in this one account, I'm about negative 1,300 SPY deltas. Effectively, what that means, if the spiders move up a buck, if the spiders move down a buck, I'm going to make or lose about $1,300, and I'm comfortable with that. You better be comfortable. And again, this isn't about being bullish or bearish. I don't care what you are, because nothing right now, but nothing on this screen is about to tell you where, again, this what I call the Twitter happy marketplace is effectively about to head. Now, there are some areas that I find rather opportunistic right now, which in fact I'm going to display to you here momentarily. But again, I just you have to respect the fact that, you know, you're one tweet away from a 30-40 point move in the S&Ps. And well, we've seen a lot of that. Again, if you're unfamiliar with this this tweet that came out right here, and that was overnight. That was actually Secretary of the Treasury. They released information that had been released months ago. The China deal is 90% of the way there. Nevertheless, they haven't talked to China in months. But the market, they bought it. And they bought it to the tune of almost 20 S&P handles in a matter of a few minutes. And that's why I say it's Twitter happy marketplace. Expect anything. Now, I also was reiterating, there's nothing on the screen that's really displaying risk. There's nothing on the screen that's kind of tipping you off as to the bias in this marketplace. Because quite frankly, if you have a bias right now, you know, you're going to have, again, that 50-50 shot. That's why this is such a binary marketplace. But I am going to show you an area that I believe to be relatively advantageous right now. First of all, let's go to the SPX, and I'll remind you, in the SPX, the expected move for the week, here it is. That's $45 higher, $45 lower. We're sitting just off the bottom edge, okay, of the expected move. Now, the interesting thing about the bottom edge of the expected move, and I'm just going to put my mouse on it for a second, it's right around 29.05, right? So what are we? Less than a 10-point move to the downside. The interesting thing, that happens to correspond with a very key level inside of the S&P futures, and that S&P level is 29.11. That's a gravity point, people. And I would succumb to the idea that we're very likely on Thursday and Friday to at least hit and actually trade in and around the 29.11 gravity point. It wouldn't even surprise me to see some news overnight come out to actually take us right into, again, that 29.11 gravity point. The markets, they love the gravity points. But where's the advantageous area in the SPX? And for that, we're going to go into the options chain. You know, there's a few things that to me are fairly striking. Again, there's a whole lot more news coming out. You know, we actually have another GDP print coming out, but they've actually got the volatility taken down all the way to 12.63% on a $25 expected move. It's light. It's very light. So on Thursday, on Friday, you have to ask yourself, and you ask yourself this, can we move more than 25 bucks? Right? I mean, if you look at the S&P futures from high to low today, yeah, I mean, come on. We did that today. I mean, effectively, we're doing that. We're making those kind of moves. So the SPX, that volatility looks relatively light. Nevertheless, they're also the marketplace is also, it's packing a whole lot of extra risk right now into, of course, the G20. You can see the G20 reflected right here. That's a 16% fall. That's the Monday expiration. And if you look out all the way, okay, into July 5th, and July 5th, of course, is next Friday. There's a day off next week. In fact, you also have a half a trading session next week. But between now and then, we have a $61 move, which ain't half bad. All right, so they're expecting a little bit of volatility to be rocking the markets, if you would, over the weekend. Now, again, the advantageous area, I would say in the SPX, I'm going to be a net buyer of option premium. You don't have to use the SPX. Come on. You could use the spiders, right? Because the spiders are going to have the same implied volatility, relatively the same expected move. You could go out there and you could use something like, the Russell. You could use the QQQ. All right, what I'm getting at over here is, again, the market is trading on this hairpin trigger. We're ready to move, and yet the volatility doesn't necessarily look like it's reflecting that. All right, enough of the spiders, enough of the SPX, enough of the risk wrapped tight. But you better have your risk wrapped tight because, again, we're about to move. And I love sessions like this where people are like, oh, nothing happened today. No, something happened. We're wound up like a top right now. I mean, this marketplace is wound up like a top, a little sell side activity over here. You kind of thinking to yourself right now, is this thing going to take the bait and just go for it? Because if you crack through 2911, you lose 2900, you lose 2900, you're a straight shot down to the next gravity point over there. Okay. And you're only, again, as I say, one tweet away from a marketplace that could come apart at the seams, or vice versa. It's actually why I've got a couple of infinity spreads on. All right, let's kind of continue this on down the list. I actually want to cruise over to the XLF for a second because one thing is definitely a standout, and that happens to be, if you compare the S&Ps, just for a second, the S&Ps have had an astounding rally. The month of June, okay, the month of June is coming to a close. The S&Ps have backed off a little bit. We're going to laugh. We're going to cry. Nevertheless, if you take a look at the XLF started the month with a blistering rally. It's done absolutely nothing. In fact, the XLF has faded. Here's the Maginot line, 2650. I would not be surprised for us to trade right back 2650 in very short order. In fact, people like it when I go out on a limb. I'm calling for it. 2650 in the XLF. A 2650 in the XLF would change the entire nature of the marketplace. Okay, that 2650 in the XLF has been just pivotal for the market. Anything under 2650 has actually been overall bearish for the S&Ps. Anything above 2650 has been relatively bullish for the S&Ps. So I'm looking for, possibly even by the end of this week, by Monday, by Tuesday next week, we're going to be riding the 2650 level. Think about it. I'll create a couple of trade ideas first thing in the morning on that front. Okay, on another front over here, got a lot of different in-out spreads working right now. One of my bearish in-out spreads starting to work is in Walmart. Again, nothing crazy. Okay. Nevertheless, I've got an in-out spread. There it is in Walmart. It's already working for me. The other one that's working for me, XLP, which is very, very similar. It's the consumer staples, similarly to the Walmart position. There's a July in-out spread. These are spreads that we actually discussed on these evening videos. So I wanted to kind of reiterate these things. They're working right now. So again, consumer staples has kind of come in a little bit. Walmart's come in a little bit. The reason I'm pointing this out, listen, right now and moving forward, as I said, the overwhelming theme of this video, keep your risk wrapped up nice and tight. Now, I know everybody wants to take positions, okay? Right now, if you're taking positions and you do not want to take extraordinary risk, I mean, this is where you go into a product like Apple, right? You look at Apple, whether you're bullish or bearish, that's up to you, okay? Because again, this is a completely binary marketplace. But right now, I wouldn't look at Apple and say like, oh, yes. I mean, you can spend all the time you want looking at that chart, and all you get is a tweet from China, a tweet from the administration. You're going to get your head taken off, okay? Go out. Make sure there's no earnings out there. Well, the next earnings is all the way July 30th. Go out. Create a defined risk in-out spread. This is what you want to do right now, all right? You want to get back. You want to keep your head from getting lopped off Okay, you go out, this is $5 widespread for $2.33 debit. There's a $12 expected move. Listen, if Apple backs off in the next 30 days, okay, you're gold. You can do this on so many different products. This is where you want to be right now in terms of trading. When I say that, I mean the in-out spreads. There are strategies that kind of come in vogue, out of vogue. Right now, this is where you want to be. Why? Okay, for the foreseeable future, again, we're on a hairpin trigger. Markets are going to be binary. There's more binary news coming out even next week. Hey, listen, each and every week, as I said, we're one tweet away from greatness or huge descent in the marketplace. With that, thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.